Next, we switch to the hands-on part of the video lessons with Proforma case, our main video project for this part of the class. So let's open Lect 1 Proforma Excel file and briefly review the case by going over the major parameters of the Proforma model. I'm going to zoom in just to the modeling piece so it's be easier for you to follow along. As you can see, the company's revenue or sales growth is projected to be 10% year over year for the next 5 years ending in 2030. This is going to be the key parameter driving many of the financial projections we are interested in, from projected total asset base, net income, all the way to long-term debt. Based on the past few years, cost of goods sold have averaged about 83% of the revenue. And we're going to assume the same for each year between 2026 and 2030. Interest rates on our long-term debt are about 5%, tax rate about 30%, and current assets and liabilities can be estimated as relatively fixed percentages of revenue at 35 and 13% respectively. The company is planning a significant expansion of its capital base, starting with a projected 500,000 next year, 2026, and increasing in increments of about 50,000 each year for the remaining 4 years of the planning horizon. For depreciation calculation purposes, we will assume the average life of new equipment is about 10 years. Okay, we start by with a growth formula, which is the last year's sales times 1 plus the sales or revenue growth parameter of 10% at the top. Make sure to fix it and then copy the growth formula to 2030, resulting in about 3.7 million. Okay, cost of goods sold calculation is just a fixed percent of sales forecast. So the forecasted sales times that fixed percentage of 83 gives us the projected cost of goods sold for the 5 years. Depreciation expense is last year's plus the additional depreciation for the current year based on the plant and equipment additions right here, depreciated over 10 years. Make sure to fix the 10 years and then copy over to 2030. Okay, interest expense is one of those formulas that disrupt the top to bottom flow of the model by referencing the projected long-term debt that has not yet been calculated. Okay, so for now, right, and then multiply by 5% fixed over the horizon. For now, we'll have the interest expense will show all zeros. Okay, and we'll automatically recalculate as the long projection figures come in down at the bottom. Okay, after calculating the income tax expense as revenues minus all the expenses, okay, from cost of goods sold, depreciation to interest, we calculate the projected tax based on income before tax and the tax rate, and finish the income statement at least with the net income calculation as income before tax minus the tax. Noticing that it's declining due to the increase in plant and equipment or the capital expansion, which then increases the depreciation expense and reduces the net income. Okay, on the balance sheet side of the model, okay, current assets are projected to be proportional to sales, right? Using the projected sales multiplying by the fixed percent of revenue. Okay. The plant and equipment is last year, right, plus the planned addition for this year. And then accumulated depreciation is last year plus current year's depreciation expense from the income statement. So you can notice how the model is crisscrossing, right? We have for the interest expense referencing the balance sheet, and here for the balance sheet referencing back into the income statement. The net plant and equipment, simply the difference between the plant and equipment at cost minus cumulative depreciation, giving us the total asset base as current assets plus net fixed assets of about 3 million going up to close to 5. Okay, on the liability side of the balance sheet, current liabilities, just like current assets, are projected to be a fixed percentage of sales. Okay, the long-term debt will initially be entered as a reference to the previous year, making it a constant 1.2 million over the planning horizon until we get to the bottom and get to the total liabilities and owner's equity. The common stock are also assumed to be fixed. In other words, no new stock is planned to be issued at this time, and return earnings are previous year plus the projected net income for the current year. Okay, finally, the total liabilities and owner's equity is simply the sum of current liabilities, long-term debt, common stock, and retained earnings. Okay, now notice the gap between the total liabilities and owner's equity projection and the total current assets, which just widens as we go further into the future. So we cannot just plug this gap by increasing the long-term debt by the exact difference between the assets and liabilities. If we do that, okay, that increase in long-term debt will make the interest expense higher, which in turn will decrease the net income, which in turn will decrease the retained earnings, and then that will decrease the total liabilities and owner's equity, which will then necessitate more debt. Okay, so without going too much into finance here, the good news is that this sort of interplay between these different financial variables will eventually converge. Okay, and for the convergence to work in Excel, we have to, under File, Options, Formulas, have that box called Enable Early Calculation checked. Then in the long-term debt cell, we implement this difference by taking the total assets, subtracting current liabilities, subtracting common stock, and subtracting retained earnings, right? And then the difference is their necessary long-term debt. And you can notice that, with some rounding error, the debt is plugged. And if you copy that to the right, it's going to be the same for all of the years. Okay, so at this point, we're going to save the file and pause.